The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. George, now that summer has passed, how are you feeling about the coming winter?
Oh my God, the winter. Crikey. Ian, I'm not even there yet. I'm still at September. So for me, the theme is wake me up when September ends. September is the only month which consistently racks up losses in terms of the market. Now, that said, we got the tail end of Q2 results coming through from the US. And of course, here we're running through H1s. But I was intrigued going through the US prints. And also, I confess, Klarna's been extolling the virtues of their potential US listing, which they've now put back on the agenda. They couldn't do it the first time around. To really try and think more about this whole notion of, why are US techs always valued above the US peer group, and try and put some thinking in there. So what we do have is some differences in terms of the operation KPIs that are coming out. So US revenue growth, and this is Q2 to date, is 17.8%. In the UK, that number is 4.5%. FCF margin in the US is 25%. In the UK, it's 16%. So you're buying different types of companies. That's going to be reflected in valuation. Now, the other side is, what is the UK better at? The UK better at profitability. So our statutory EBIT is 12%. In the US, it's -3%. We're also better at DPS. However, when it comes to looking at the software sector, you're always concerned about the sort of what's the North Star saying, which is, of course, the rule of 40. US guys and gals, 43%, UK, 21%. So there are operational differences coming through between both markets. And of course, the companies are different as well. And then that rolls up to a sort of an average valuation. So looking at it from a PE perspective, US PE of 29, UK 18. However, the grudge for me is that this valuation gap totally disappears when we're looking at it on a stock by stock individual basis. So just to pull out some examples there, in the Sage sphere, so there you're looking at sort of financial and accounting software guys. Sage trades at a discount. It's on a P of 26, Intuit 30, Microsoft 33.
So it's not a substantial discount.
Absolutely. In the IT services, IT professional services, Kainos trades on 22. Accenture is 18. Capgemini is 10. You're going to say, George, these are big and ugly companies. That's not a fair comparison. So companies who are more of a similar size, Netcompany out of Denmark, trading on 16, Bouvet on 16, and over to Italy, Reply on 19. So there's no big discount. In fact, with Kainos, it's a premium.
Has a bit more software selling in there then.
Has more software, but so does Accenture, so does Capgemini. They all have some of that.
In their own special way, yeah.
Looking at sort of the semis and hardware, Raspberry Pi, 38 times. Nothing to ARM, 67 times, but AMD is on 30 times. The IT infrastructure space, so Computacenter on 13. US peer, CDW on 17. Insight, another US peer. In fact, Insight is a decent global comp, and that's on 11 times. Athia on 15.
Softcat bites at the moment.
Softcat is on 30. So that blows the theory in that area. But it's not just this. If I look wider in the tech universe, say on recruiters, Robert Walters is on 8. Adecco is on 7.6. Hayes is on 12. You're going to say, what's S3? It's on 6. So for me, it really talks to valuation is dependent on the underlying merits of the company and not at all on the strength of where the venue is. So why some of the big differences with the US? The US tends to attract companies that have bigger in scale, and they also have some amazing valuations out there. I mentioned ARM on 67 times, but also stuff like Snowflake on 250 times.
One of the things that comes out when you look at it is I feel that it takes the UK market a little bit longer to get comfortable with this. Some of these companies you've been talking about there, they're all relatively well established. They're fixed in the mindsets of the UK investor base who now understand what they do, who accept that they've got a long track record. So when we compare the two markets, there are things that we miss, like how long does it take you to get to the rating, as it were, your equilibrium, your long-term rating versus the market.
Super point. The 4 companies I talked to from a product lifestyle perspective, they're all sort of later rather than earlier. And clearly one of the defining attributes of London is the fact that we have a whole bunch of earlier companies, guys on AIM who from a product life cycle perspective will be at introduction, trying to get into growth. And there, I hate to say, valuations are all over the place. And there you also tend not to draw a US comparison because in the US, your market cap to get on the market has to be around $1 billion now. And then also the companies are just bigger because that suggests companies that are later stage in terms of their life cycle. But if you're looking at something like Computacenter has always traded on this narrow band of PE, somewhere between 12 and 15 times. What you can't have is a broker getting on the phone saying, I see this being re-rated to 20. Both of us know that will never happen. At the same time, you said, no, that's not so bad for Sage when we were talking about the rating there. But we can still go back to a time, both of us, when Sage was forever on its narrow rating, somewhere between sort of 15, 16 and 17 times. I confess this year what we're seeing on Sage is a story of derating. Stuff like Intuit and Microsoft are not comparably so much more expensive given their underlying product narratives and what they're doing. So for me, it's almost not that Sage looks expensive, it's that the other guys look cheap relative to what Sage is doing. Kainos, it's a sadder story. As you'll know, that one was a superhero in terms of the market and its rating was on 30 times. And that's been a story since COVID, really, around an underlying derating of that share.
You almost worry that by the time the UK market has learned what a company does and accepted what it does and how it's going to grow, it's too late because it pretty much then goes ex-growth.
Ian, ring a bell when you say that phrase, by the time the UK market realizes, because I want to embarrass you right now here. Ian, you were the perma bear on a lovely company called IQE. It will surprise you to your very core that they've warned again. On the back of their warning, though, they tacked on a little statement saying that they're now in offer period. So somebody wants to buy IQE. Panel has allowed them to stay silent on who the potential bidder might be.
Unless someone guesses.
But the share price continues to stay in the tank. What would your view be now on IQE? Has the market finally woken up to your view on it?
Well, my view actually has changed over the years. I do feel that this is a stock that's eminently rampable because of what it does. It is so bleeding edge, always going into new areas because of the nature of the epitaxy and gallium arsenide, gallium nitride. So it's either got no story and it's in a cyclical downturn, or it's got a hold on, boys and girls, it's going to go up. And that's always been easy to run, should we say, for the brokers. As far as what we're looking at the moment, we're looking at, in the words of Americo Lemos, the former CEO, a lot of ovens, but bits of kit that are going to be difficult to move, highly technical. It's a limited second-hand market. Are you selling a business? Are you selling capacity? I look at how the market has developed in terms of what this company does as an outsourcer of a process for other companies, and it's been stuffed by movements beyond its own control. It started out saying, hey, this is a difficult thing to do. Let's go and be an outsourcer of technical skills, which actually, to start with, was an extremely good model to do until everybody else in the industry started moving down being an outsourcer. And then you become an outsourcer to an outsourcer and you start thinking, actually, this is a bit difficult. And who's going to want to retain the technical skill set of being the guy who understands the process? So you see the skill set drawn back up into your customers who are now outsourcers rather than integrated semiconductor manufacturers. Where does it go? The phrase picking up pennies in front of a steamroller is very much applicable here, I think, which is a shame because there's a lot of clever people there and perhaps it's a victim of the market rather than of actually being a bad company in itself.
The share didn't rally on news of their in-offer period. Does that suggest to you that the offer may not come to anything?
It suggests that no one really knows what's going on, to be perfectly honest. It feels like it's a second-hand fire sale, a lot of expensive bits of kit. It's not really an ongoing business. All the kit is spread internationally, an awful lot of it in Wales. That's great, but there's not a lot of other manufacturing going on in Wales in the semiconductor industry. It's a shame, but it should probably have never got so big on so much public market funds, really.
Speaking of bits of kit, Computacenter had H1 results today. Selling a lot more. Revenue there was up 28%, which was a stunning result. Buried in that, though, is that it's US buyers. In terms of the underlying business model, 20% of revenue is services there. However, because they're doing so much on the kit side, gross margin took a turn for the worse. That's now down to 12.6% from 15% a year ago. And then, of course, that feeds through into EBIT. So statutory EBIT is now at 1.9%. The cohort group, their average is 4.6%. But where I've gotten wrong on Computacenter is a kit story. I've been talking about the great restocking as that whole Microsoft migration gathers pace, and plus Microsoft had the change in terms and conditions earlier this year. So you saw a warning, not just from Bytes, but Athia had one as well. And of course, Concam had one. None of that from the guys at Computacenter. However, although inventory monetary value ticked up, the inventory days calculation actually ticked down by 2 days to 17. Now, as we both know, inventory just locks up working capital. If we go back to sort of pre-COVID, the guys were doing 30 inventory days. So arguably, they can still pull out some working capital from that as they work down the inventory. But it was such a strong story out of America today. America is now, by the way, 42% of profit. A year ago, 24%. So shares opened up 9%. So investors really loved it.
How much are they having to put in terms of working capital, general effort to build the US business? Is it massively working capital consumptive?
Well, as you know, with resellers, it's an entrepreneur model. So you're begging from Peter and begging from Paul. But they acquired businesses there. So it's just been about scaling the underlying infrastructure of the businesses. Now, this half was difficult from a working capital perspective. And I recall FCF margin was negative. Now, it can often be negative, and that's just the movement of inventory, negative in H1, and that tends to unwind in H2. So there was an influence, but my interest in it was to sort of roll back on the geographic story. Where they've been feeling some pain is in France and Germany, selling into public sector in there. I was reminded of Gamma, because Gamma has been a big story on the success of Germany.
Yes, for years, been troubled, should we say, by their ventures into Germany. They weren't as successful as they'd hoped originally when they bought in a few years back, sort of pre-COVID times. It was this German market is going to go to cloud communications, and it's going to do so very quickly, follow the UK model. And of course, that's actually not what has happened. The Germans are far more stick in the mud. They're very happy with their old school PBXs and their boxes in the corner, and they're not going to software-driven communications, which is a frustrating situation. But in the last 12 months, Gamma have taken a big step forward in making 2 big acquisitions. One, which is a company called Placetel, which they bought from Cisco. So it's Cisco's in-house reseller that they were using to get to market. And they also started the year, they bought a company called Starface, which is what we described as a cloud communications company where they had developed their own kit, which I suppose in some ways was the sort of more traditional model. And they bought that business and they've driven it hard, and it has shown some good growth. I think when they bought it, people were very concerned as to how much they were paying for it. But certainly the results that have come through, sort of low, mid-teens organic growth is coming from these businesses. So they look like they're sensible businesses. It looks like what was a strategic question mark for the group now looks like it's coming good, because they're now the leader in the alternative software IP-based communications solutions into the German market. And we do expect that market will take off eventually when the Germans sort of get their act together and accept the benefits that cloud-based connectivity has for everybody.
Reading through the CEO statement, my impression is that he was sort of telegraphing more M&A, which for me is just what they should be doing. What's your take, Ian, on it? Because we're in an environment of share buyback.
We are in the share buyback, got to do a share buyback. I think going through the years, when you make an acquisition, it doesn't go quite so well. There is always sort of a reticence to do further big ones. And up until sort of 8-9 months ago, they weren't making huge acquisitions. But these two German ones are very significant acquisitions, and they have shown that the management have got the balls to go and do deals. When you look at the product portfolio that Gamma has in Germany, it's pretty much got what it's got in the UK. And that is a set of businesses that appeal to UK investors because they're cash generative and they can fund share buybacks. But going forward, a couple of gaps in that portfolio. Connectivity is one. That means sort of basically connecting companies, be they big or small, to the network. That's actually not been as slick in Germany as you might have expected. The whole sort of broadband transition has not been perfectly executed. And that's been part of the reason for the slower than anticipated take up in broadband IP software communications systems, because you're relying upon new technology and the broadband connectivity that hasn't been consistently there. The other bit of the business that they're missing at the moment in Germany is the enterprise, the larger businesses, the public sector customer base that they've managed to build in the UK over the last few years.
They roll back to my comments on Computacenter in Germany, moaning about the public sector market there. Maybe that hasn't been such a bad thing to date.
Yes, they're probably not missing it too much at the moment. And I don't think it's something that's going to happen this week, next week, the next few months. But it is clear that if you have got the opportunity to build another a Gamma UK replica in Germany, and it seems odd that the share price should have reacted in the way it did to today's results. Perhaps people are frustrated by the lack of growth and the difficult market in the UK. But I think really, given what else has gone on in the UK and the news flow we've had,
market in the UK is not a surprise to anyone.
It's not really a surprise, but really neither should an ambitious management team not wanting to do share buybacks when they've proved that they're able to do good value acquisitions.
That is correct. Absolutely. On that bombshell, Ian, we've covered the waterfront and we've boiled the ocean as we've looked into UK, US and continental Europe.
Yes, and hopefully we'll get our heads out of the economic maelstrom and actually look at businesses.
A pleasure to chat, Ian. Looking forward to the next issue.
We'll talk then.
Brought to you by Progressive Equity.